Hey everyone, and welcome to this explainer. Look, if you've been tracking the electric vehicle or AI boom lately, you've almost certainly bumped into ON Semiconductor. Today, we're unpacking the really fascinating valuation crossroads this company finds itself at. We're going to look closely at the driving forces behind their 2026 projections to figure out a huge question. Does the current market reflect genuine, long-term value, or is it just masking a really dangerous cyclical risk? Let's dive right in.
So here is our roadmap for today. We're going to cover Section 1, from cyclical to premium, Section 2, the valuation crossroads, Section 3, risks plaguing the recovery, Section 4, opportunities fueling the future, and finally, Section 5, the analyst consensus.
All right, kicking things off with Section 1, from cyclical to premium. Let's look at their historical journey.
To really get what's happening with ON Semiconductor today, you've got to look back at their dramatic pivot. Before 2020, the market basically treated them as a standard, run-of-the-mill cyclical chip supplier. They were totally hostage to the basic ups and downs of auto and industrial demand. But then, this massive transformation happened. They pivoted incredibly hard toward high-value power and sensing markets, and they managed to time the EV boom absolutely perfectly. The stock surged, and earnings expanded into this premium valuation zone. But recently, well, that high met a pretty painful reality check. A really harsh inventory correction as demand finally started to normalize.
And honestly, this is the trap so many investors fell right into. The huge historical mistake was assuming that every single bit of that pandemic-era growth was some permanent structural new reality. They completely ignored the massive cyclical tailwinds happening in the background. You know, things like incredibly tight supply and customers aggressively hoarding inventory. When the inevitable corrections finally hit the automotive and industrial markets, that illusion shattered, and the stock's valuation compressed incredibly fast.
Which brings us nicely to Section 2, the valuation crossroads. Here is exactly where ON stands today.
So right now, the stock has rebounded pretty strongly from its lows, trading right around $17. The market is very actively pricing in a recovery, but it all hinges on one absolutely core question. Is this recent recovery just a temporary cyclical bounce, or are we looking at the rise of a truly durable earnings compounder? The risk-reward is definitely much more balanced now, but with the stock already moving ahead of the absolute bottom, flawless execution from management is going to matter more than ever.
Okay, let's get into the rough stuff. Section 3, risks plaguing the recovery. This is the bear case.
Look, with the stock moving ahead of the trough, execution is critical. Any disappointment could literally tank the multiple. First up, the automotive cycle. Demand here can swing violently, from a massive shortage to a huge excess. So if EV makers suddenly hit the brakes to clear out their inventory, ON's revenue takes a direct hit. Second, industrial demand is still really cautious. Factory automation just isn't bouncing back as fast as everyone hoped. Third is silicon carbide. Yes, it's a strategic goldmine, but it is insanely competitive and wildly expensive to scale. And finally, you've got global EV pricing wars adding a really thick layer of fog to their near-term visibility.
38.5%. That was the company's Q1 gross margin. Now, it actually beat fears and Q2 guidance points to things stabilizing between 38 and 40%. But here's the catch, and it's a big one. That 38.5% perfectly illustrates the dangerous margin tightrope this company is walking. To actually justify a premium valuation moving forward, one single quarter of stabilization is simply not enough. They need sustained, proven improvement driven by relentless manufacturing efficiency, a better product mix, and way higher factory utilization. Let's flip the script. Section 4, opportunities fueling the future. Here is the bull case. Because there really is massive upside here, guys. In the short term, relief is finally arriving as those really painful inventory corrections normalize, which actually pushed Q1 earnings up to 64 cents a share. But the long-term structural runway, that's where the real magic happens. Think about it. Even if total global car sales completely stagnate, the sheer volume of chips packed into every single new hybrid and EV gives them a massive growth lever. If they manage to scale their silicon carbide tech efficiently, they are going to capture a highly lucrative slice of the entire EV and industrial power markets.
And we absolutely cannot ignore the AI factor. No way. While ON Semiconductor isn't out there building the flashy GPUs powering your chatbots, they provide something arguably just as important, the actual electricity to run them. AI data centers are essentially massive power plants in reverse. They require immense power conversion and protection capabilities. And based on third-party projections, ON's AI data center revenue is expected to double by 2026. Double! This adds a completely new, high-octane dimension to their whole recovery story.
So where does Wall Street stand?
Section 5. The analyst consensus, Wall Street's verdict.
When you balance out all those cyclical risks against these incredible EV and AI opportunities, Wall Street is left looking highly constructive but extremely cautious. Out of the analysts covering the stock right now, the vast majority, 19 of them in fact, are sitting safely on a hold rating. We've only got 13 buys and just a single strong buy.
But you know what's truly revealing here? It's what's missing from those ratings. There are exactly 0 sell ratings. None. The market isn't broadly bearish on the underlying business at all. Analysts clearly see the long-term potential. But that massive block of hold ratings proves Wall Street is demanding hard evidence. They want to see that Q1 stabilization turn into a real, undeniable multi-quarter earnings recovery before they pop the champagne and fully buy into this premium compounder narrative. So as we evaluate the road to 2026, you've really got to weigh the evidence for yourself. Inventory is normalizing, the AI and EV exposure is very real, but those cyclical risks of auto demand, they're definitely still lurking in the background. So I'll leave you with this to think about. Is this recent rebound just a temporary cyclical bounce, or are we literally witnessing the dawn of a massive, highly valued new earnings cycle for ON Semiconductor? Keep a really close eye on those upcoming quarterly margins for your answer. Thanks so much for joining me on this explainer.